G'day, money miners, buddy. Mate, we're about a bit of a party today, courtesy of the sheriff. We've got a bloody, I don't know, can you see this on screen?
Oh,
Look at this.
you might see in your
on
frame.
the wide screen. Bit of a bloody, look at the little cheese platter we've got going on.
We're
Some
celebrating
olives.
sort of the last podcast day we have to talk about quarterly, so we've put out a little cheese platter to celebrate.
God, we
which
should have had a bloody vino
as well. I know, but I mean, we did kind of eat most of it in the preparation, but there's leftovers.
I ate way too much. I didn't even go get a banh mi off Q. So Q, if you're listening,
You've
I'm
just
very
had like
sorry.
6 wheels of cheese, but that's okay.
Cheers, Sheriff. Buddy, right, we're going out of our realm of expertise today.
Diversified
Minres
miners.
and IGO. Hey, if that's not a bloody Trav and JD segment, if I've ever seen one.
Yeah,
But
I know.
anyway, we're much the wiser, aren't we, GC? Speaking of
are.
Trav and JD, they've confirmed alive in this photo. They are at some South African mine site. I
Yeah,
think.
so touchdown in Africa. Look at them all smiling and thumbs up and having a great time. So, so they'll be at Indaba next week as well.
So is CRE Insurance.
Oh,
They are also at
Tari,
Indaba.
Trouter, and all the rest of the team.
Yep.
Love
They
it.
actually prompted Trav and JD to check their travel insurance, which was like,
They actually did.
and they had their
Very
oh,
good
shit.
suggestion.
Buddy, Trav should probably insure himself over there, walking around with a bloody money and mine shirt. Those Sierra Rutile folk might get a hold of him. But as we said, say good day to the CRE team, the African mining insurance experts in the broking world. So, mate, Steve and Trouter, they spearhead the Perth office. Mate, they change currencies in insurance and get money in and out like butter and a piece of toast. Like it's just
Easy as that.
absolute, just normal start to the day for them. So, mate, after Tari gets you a bloody better price on your premium and or better or more protective cover on what you already have, you won't be saying thanks, Steve. You'll just be saying tar.
Jesus.
Go CRE Insurance.
Go dad jokes.
Right, let's take it away, JC. Minres, ding, ding, ding for you.
Yes, so they released their quarterly today. So it was a bit of a mixed bag. Some things were come up a bit better than expected. Some things, a bit below expectations, but certainly all eyes were on the net debt figure and how the Onslow ramp up is progressing.
Pretty simple, eh?
Oh, just so simple. Diversified mine is so out of my wheelhouse, but I'm giving it a crack today. They're off a little bit today. Last I checked, there was like 1 and a bit %. So let's do a bit of a highlight reel of the quarterlies while you enjoy some cheese and crackers there. We'll swap when you do IGO. So first thing, they said they're maintaining FY25 guidance across all continuing operations, but at present costs are generally running above guidance at this stage, so they'll be needing to make sure they deliver a lower cost second half to make sure they meet those guidance ranges. But we'll have a look at this in sort of each business division as we go. So first, cab off the rank. What is happening at Onslow? How's all that going? So they're progressing towards a 35 million tonne per annum nameplate run rate, which they're expecting to meet in around June time this year. So for the quarter just gone, December quarter, they produced 4.4 million tonnes. So that's an annualised sort of run rate of 17.6. They mentioned, I think, in the previous quarterly, they were looking to do around 18 by December. So they sort of pretty much got there, a little bit unders.
Probably had, and was that more in January, like old tropical cyclone Sean?
Yeah, so then there was
from that.
Then there was that as well. So they're actually expecting in this month, January, to produce 1.6 million tonnes, which if you annualise that, that's a 19.2 million run rate. So that run rate is stepping up, each time, but it's just, is it going to step up to 35 million tonnes, when they're sort of saying sort of that mid-June, but it's heading in the right direction so far. OPEX, $77 a tonne for the first half, which again, as it ramps up, that'll be expected to trend down, sort of within that guidance range of $58 to $68 a tonne. They reckon Onslow's been sort of operating cash flow positive since November last year, and that $800 million Onslow carry loan, which is a receivable for MinRes, is now starting to get repaid as that sort of free cash is generated. 3 transhippers operating at nameplate. The 4th one due next month in February, the 5th in April. As you mentioned, Maddie, shipments were sort of impacted by Cyclone Sean sort of earlier this month, but also some unplanned downtime on a port reclaimer, which has since been resolved. The cyclone did affect the haul road as well. There's a lot of flooding. And that haul road had a bit of truck rollover incidents last year as well. But the haul road now is in full operation, and they're sort of just doing final works to finish all of that off this quarter. But the iron ore division more generally, sort of, they produced 8 million tonnes at an average realised price of US $84 a tonne, which is a slight improvement from the previous quarter. And obviously the main update there outside of the Onslow progress is that Yilgarn's now on care and maintenance.
And up for sale, eh?
Seems like it.
But whether they'd be able to sell it, not known.
Yeah, they might. Yeah, there's the assets, and then all the sort of infrastructure and other perhaps fleet equipment, things like that. But
might be some beryllium up there.
Beryllium. We talked about that yesterday.
Yeah, and I got one of the comments. One of the fundies predicted beryllium was the commodity to watch this year.
I'll be completely honest. I have no idea what that is.
Mate, we need to get onto that.
Alrighty.
Yeah.
Let's do it.
Right, mining services.
Mining services, which, the heart of the MinRes business, they did 68 million tonnes, which is pretty much same as last quarter. They believe sort of production volumes are more second half weighted, sort of in line with the Onslow ramp up. And they positively said they secured 2 new contracts, a rehab and a mining contract, and renewed 4 existing crushing contracts.
Okay, the old the forgotten child that was the breadwinner, the lithium.
The lithium child, yes. So there's been a bit of change in this part of the business. So attributable spod production of 136,000 tonnes. It was lower than last quarter, which was about 157,000, but that was sort of part of a previously flagged focus to transition to lower volume but higher quality production with given all the lithium market conditions and things like that.
So what they're like in terms of what Pilbara produced, 180,000 tonne, I think it was. So,
something like that.
Yeah, and they were down from 220. So that's, I suppose, it's just showing how big their business is compared to Pilbara. So obviously a bit smaller on output. Yeah.
No, that's right. And similarly to some of their peers, they saw their sort of average realised SC6 price improve. Min's actually sort of got a slightly better, realised SC6 price compared to some of their peers as well, but they got $827 a tonne.
I suppose like your Mount Marion, but if you once you convert it back, like you might be getting a good realised SC6 price, but you're getting pretty bloody low when it's that Mount Marion grade.
Yeah, that's right. But I think more so it was more interesting, I think, more from a sentiment and sort of price movement type of angle. And Mark Wilson on the call reckons, I've got a belief, and the business has a belief, that the lithium market is not going to stay at US $900 a tonne for the next 5 years. So, and it was just interesting hearing that comment along with some comments Dale from Pilbara had the other day, sort of saying he reckons prices are sort of bottomed out. The edging up of prices since last October, could be the start of a longer term upward trend. So, is this very, prolonged lithium winter, is it starting to defrost a little bit? The sort of sentiment's changing a little bit. These look, mind you, the prices haven't gone, to $1,500, but it's like you're seeing these sort of little micro wins every quarter. I just thought that was interesting. Yeah.
Well, and you think, like, if it just goes up $80 or $90, that is
In relative terms,
That's
it's
the same
decent.
as bloody gold going from 4,000 to 4,400.
Yeah.
Like it's pretty big effect on these large ton operations.
Absolutely.
What about like each
Each mine.
site itself, GC?
Yeah, so Wodgina shipped 61,000 tonnes at a 5.7% grade. So they're sort of accessing more fresh ore, and they've sort of cited some recovery improvements there as well.
So that's a lot higher percentage, isn't it? Like compared to what like your Linetown and that are pumping out at 5.2, 5.3 if they're doing 5.7. So it's obvious it could be a metallurgical thing.
They sort of cited a bit of both really. And then Mount Marion shipped 55,000 tonnes at 4.4%, so that grade we were sort of talking about earlier.
But that's lifted a bit.
That
was in the high threes.
Yeah, so that has lifted. They've had some plant improvements as well. They said they completed the underground development there. So now they're just continuing with study and approval works to basically support a future underground restart. When that time's appropriate.
It's always sad seeing an underground stop because it's a home that a Sandvik bolt
could have gone
had, but it doesn't have anymore and has to be relocated. It's like a dog going to the pound. But I suppose as the developed jumbos and the developed people went to another contract, like the Sandvik bolts usually follow them, so it's okay. Like, look. On a very small scale, considering the Sandvik Ground Support Division GC supplies Olympic Dam, Freeport, I would assume, based on supplying them too, they probably supply Oyu Tolgoi as well. Like,
these are some big mines.
They're the biggest underground mines in the world. So tried, proven, tested, and run by Derek Hurd, the Sandvik Ground Support Division. So just go Sandvik Ground Support. What makes you think that if they can't supply those biggest mines, they couldn't supply your small mine? Give them a buzz.
Give them a buzz
to make that happen. What about
costs?
Costs, yes. The moolah.
The moolah. So FOB costs for both Mount Marion and Wodgina are in the low 1,000s, or they expect to be in the low 1,000s at this stage. So, and they're still saying they're expecting to reach those guidance levels. So we'll flash up the table here. You can see sort of where they're at for the first half of this financial year and where they're sort of guiding towards for the whole financial year. But remember, back end of last year, they had a lot of those cost reduction measures sort of flowing through the business and things like that. So I imagine that will probably start to have a little bit more impact on the cost per tonne basis in the coming months and quarters. And also, of course, you had Bald Hill. They shipped 27,000 tonnes at 5%, but they're now that's now in care and maintenance. But it sounds like they're sort of still continuing to invest in the lithium operations to a point. To basically harvest when the market rebounds, that sort of a thing. That was the sort of rhetoric.
Right, the balance sheet, the debt, GC. Where's the debt sitting at?
Oh, everyone loves talking about the net debt.
Is this your first day really delving into the MinRes
balance
sheet?
It is. I've come up a very big learning curve. So there's sort of a lot
of cheese in the progress.
With a lot of eating a lot of cheese in the progress. Actually, funnily though, I am wearing my free cash flow hat as well. I'm not sure if you can see that. I thought I'd better put that on for a quarterlies day as well. But anyway, I digress. So back to the balance sheet. So there's total liquidity of $1.5 billion sort of expected as at 31st of December. So that includes around $700 million of cash and $800 million of undrawn, revolving credit facility. Net debt figure has been expected to come in at basically $5.1 billion at 31st December. For context, back in 30 June last year, it was 4.4. Current market cap is around $7 billion as at today, for reference. So some of the key drivers that were, that affected that net debt balance. The Hancock gas assets deal was done back into last year, so they got $780 million of that in the door. They sold the 49% of the haul road. That was $1.1 billion. But then sort of coming out the door was $1.4 billion of capex, which was largely driven by Onslow. There was a net working capital unwind of about $500 million, so trade payables decreasing. And then $200 million due to Red Hill post first ore on ships for Onslow. And then because of the weaker exchange rate, the Aussie US dollar exchange rate, there was a $300 million valuation and revaluation of their bonds as well. So when you mush all of that up, basically, amongst other things, that sort of got that $5.1 billion number. It was a bit more than I think the street expected. I believe consensus was more in the mid-4 bills.
Yep.
But on the call, they said they were comfortable with the net debt position, and by June, the business would be, transformed with a free option on lithium. And they reiterated there was, no financial covenants on the bonds, and they continued to trade above par, and that they weren't really expecting any material payable unwinds to come, and believe that they're now at peak leverage. So, big numbers.
Much? Did you read much into how much has been spent on Onslow versus how much remaining for big ticket items? I assume another 2 transshippers on the way. Like, that's pretty big capital. But you'd think the road being close to finish, there'd be a lot of capital that have been spent already.
I think it was very first half weighted, to be honest. There was some figures in the quarterly, but not a whole bunch of detail. But yeah, very much sort of first half weighted. But yeah, there's still obviously, there's more transshippers and things like that to come as well. But there's also been 1,200 odd people leave the businesses since the start of FY25 across, head office, and there's 2 operations that have gone into care and maintenance. Construction activities have wound down. There's been those roster changes as well. Yep. So that's happened, but they did sort of flag there would be more detail on CapEx to come with the financials, or half-year financials, which is in February. But they signalled scope for further spending now that they have the cash from the sale of the energy assets. But I think really sort of reading through all this information, the key to this is just keeping Onslow on track and hoping, maybe get a little bit of a bump in, commodity prices and things like that. But that is just so critical here. But, they've in previous calls, they've mentioned, they've got other levers that they can pull should they need to. But at this stage, there was nothing further. What else? Sort of other bits and bobs. There was nothing really on the governance issues or the leadership succession plan in the quarterly. There was a bit of sort of...
I reckon watch that just never really be talked about.
Yeah.
And gets to 12 months down the line, they're like, oh, wasn't he supposed to be leaving? No.
Yeah.
No, we didn't say that. Because there's like, as you'll hear from the chat with Romano tomorrow, as with MinRes, his biggest holding, I think.
I think so, yeah.
So, he doesn't want him to go anywhere. So there's obviously still there's some there's obviously different sides, but there's a shitload of support for him not going anywhere. So
so that was pretty quiet on that front today. And the shorts have they really did spike up the back end of last year, but sort of pulled back, but they've sort of been steadily increasing a little bit since November, according to Shortman. But that was sort of a bit of a quick highlight reel from today's quarterly.
But you think of what's in the iron ore, and you look at just me old bush maths. You just look at the lithium they produce compared to Pilbara, and like if they're getting valued for not much on the lithium, if there is that bit of rebound in lithium, they've got a lot of leverage to. Bloody lot of talk to benefit from a rise in the lithium price, especially because they can, turn Bald Hill back on, and they can, really, you know, pull the levers to make a bit of cash when they need to. So
Yeah. I mean, obviously with care and maintenance, I mean, it's, even though it may be a suitable environment to turn things back on, you know, there's a process and cost to do that. But, you know, if the fact that they've got those assets is, you know, a plus, and it's just a matter of when it's sort of a sustained period where it is a better, you know, environment, you know, you've got them there, take a look and go from there, sort of thing. But yeah, I think the interesting sort of period of time, or the crux point really, will be probably more middle of this year, back end of this year. That was sort of the feel I got having a look at this today. So,
seeing if the Onslow fruit starts
yeah,
coming off the tree.
because that'll impact it a fair bit. So yeah, I think that's the real key period to watch. So yeah, that was my little highlight reel there.
Oh, go you, GC. Righto. Let's get on to IGO,
I'm just going to get a cracker now as well while you do that.
Oh, you're right, do you think? Just chew it right into the microphone too. that onion, the French onion dip, she was a bit rich, but it's good, but I had too much of it. Yeah. Right, IGO. She was a tough quarter, it appeared. They didn't deny it at all. They've still got the Kwinana impairment to come, which they flagged before the quarterly. Yep. So that'll come in the half year accounts, I would assume. So cash went backwards in IGO by 12 million. So look, Nova underperformed. Sounds like the grade, because it's sort of the production, the rock factory that they could just, get a bit of easy cash out of because it's getting that into life. But it sounds like the grades on the, the fringes of the ore body that they were talking about, that they're sort of at now, and they sort of aren't reconciling to what they plan to get out of it at the end of the life. So not sure of the setup there, but when you get to nearing the end of a mine's life, you're taking out all the shit pretty much, because all the remnant areas, it could be the levels in between mined areas, which could be challenging, but it could be it's usually the shittest grade that's left, because why would you leave the good stuff till the end unless you cannot take it for some other reason? Whether a lot of stuff usually gets left by early management, they're like, I won't be fucking here then. So it won't be my problem. So it's always challenging the last bit of a mine life. But so, they still said they generated 14 mil free cash from Nova operationally. But sounds like it could have been a lot better, because you've seen how much the nickel output dropped from that. So sounds like there's a bit of work going on in the background to sort of properly model and guide what's left there, what they expect out of it in terms of grade and tonnage, and hopefully hear about that in the coming quarters. So still, and you see on the waterfall chart, he's still spending 16 mil on exploration and evaluation. So they're drilling in and around Cosmos. So Ivan said on the call, there's a few things that, need to be squashed or closed off, or nails hit on the head effectively before they walk away from it. So they probably bloody deserve a bit of an exploration Hail Mary, IGO, considering since they've bought Nova and became IGO, they haven't really had a massive exploration success. So they probably spent a bit of coin on it. So yeah. So that. Now, the thing I'll go into here, just as a 101 that I've given myself and that I'll give the other people, is
please help me.
Because there's cash in IGO, but then there's the JV for the whole Greenbushes and Kwinana arrangements. I'll go step through it for those who don't know. If you already know, just fast forward. So you've got the Winfield JV. That is what owns Greenbushes. So that's 51% TLEA, like Tianqi Lithium Energy Australia, I think it is, and 49% Albemarle.
Okay.
Yeah.
But
then
TLEA,
that 51% that holds Greenbushes, is made up of 51% Tianqi and 49% IGO. So effectively IGO have 24.99% of Greenbushes. So TLEA owns 100% of the Kwinana facility. So TLEA owns they got a bit over half of Greenbushes, 100% of the Kwinana downstream hydroxide.
Facility.
So for IGO to get a dividend from TLEA, so when they talk about that's the cash they get. You'll see on the waterfall chart, there's nothing on there that is anything to do with Greenbushes, because all IGO get from Greenbushes and TLEA, which includes the hydroxide, is either a dividend or they would, in worst case scenario, have to put money into it.
Yes.
So it doesn't show up on their waterfall chart. So for IGO to get a dividend from TLEA to show up on that waterfall chart, so you need Greenbushes to make a shitload of money.
Yep.
Because if it loses money, they'd have to tip money into the JV. But you would hope, based on, I'll go through the operating costs later, you don't think Greenbushes will lose money unless there is a catastrophic event or a lithium price, even worse price.
Yeah.
So that money made in that Winfield JV between TLEA and Albemarle is then used to operate, fund the growth at Greenbushes, service the debt within the Winfield JV. Now, that Winfield JV debt, that got upsized to $1.55 billion US in June last year. And a lot of that was used to fund CapEx at Greenbushes for Train 3 and the TSF4. Not sure if it's fully drawn. I think it's close, but I heard like the Winfield JV effectively took on more debt so it could release a dividend because Albemarle needed cash.
Okay.
I think that's sort of
right.
Yeah. So sort of debt paid a dividend. I'm not sure if it sounds cool anyway. So then the money after the Winfield JV that then goes into TLEA, like that has to service the Kwinana downstream
As well.
facility, CapEx and operating and everything, then like TLEA itself. And what's left from that will then be released as a dividend to Tianqi and IGO. So last reported in August. So IGO's share of the TLEA net debt was $415 million. So that's effectively the debt within the Winfield JV, IGO's quarter of that. So it's implying that was 1.6 Aussie, but it's US dollar denominated. So I would imagine since that period it would be, there's a lot of, and they talk about it today as well, the FX when they're talking about EBIT, because when they talk about EBITDA and everything, they're using the values within the Winfield JV and TLEA, but like as the book value and all that, but it's not getting used on their cash flow at the moment but in terms of the financials, the accounting side. So there is going to be, once those accounts come out, there will be like obviously the FX increase and then the update on what the debt is. So yeah, as I said, what's left over, if everything's going well and the debt's serviced and Kwinana CapEx has been satisfied and it's not losing too much, that's how IGO get a dividend. So because FY23, those dividends were $1.2 billion to IGO when lithium was humming. Then they received a further $761 million in dividends in FY24. But unfortunately for FY25, they have and are likely have and will receive zero for the whole of FY25. So they haven't received any yet, and they've said in the announcement that they are not expecting a dividend out of TLEA. So look, considering they paid $1.9 billion for their stake in TLEA, which is Greenbushes and Kwinana, those dividends have paid for that acquisition. I'm not sure if they had to tip in any more money into that JV or if that
was their only outlay.
That was the only outlay. I'm not sure. So they've definitely made hay while the sun shined. It's just pretty bloody overcast at the moment, you'd say. Yeah. So it's the risk. Like you think of it, it's like you're a non-operator. You're like a bloody Gold Road sort of thing. Like you're just hoping that, and it is aligned in terms of the two customers of Greenbushes are Tianqi and Albemarle. So they are, but they're the shareholders as well. They will want to, you would hope, keep the costs down operate it the best they can to make bloody money out of it, and then it guarantees their supply, but they obviously want to make money out of the operation as well. So it sort of circulates all back to themselves in a way. And like talking about Kwinana, because I get a lot of questions about the marketing rights and everything like that, thinking that, Tianchi got all the power and IGO haven't got any. But look, it was pretty repetitively said today, like this is the arrangement, this is how the money flows, how I explained it before. He explained it much quicker than I did, but it flows from Winfield to TLEA, then to IGO, and it's all a function at the moment of obviously lithium prices are not that good and they're expanding Greenbushes at the same time. So for Greenbushes, I'll go into the figures after this, but I guess the one bit was like the lithium sales were down compared to what they actually produced. And, everyone the scuttlebutt starts going around that, stockpiles are building up because Tianchi last year didn't take product, and that's going to see inventories and they've got the control. So because you see that lower shipped to production number, that narrative gets going. So let's see what Big Ivan had to say when asked about inventories directly.
Let's have a listen.
The next question comes from Levi Spry with UBS.
Can I just quarterise that question on the inventory build-up though? So how big, what are the stocks on site? How big was the ship that was missed? And do you expect all inventory to be cleared by the end of the FY or end of the Tianchi's FY, the calendar year?
I don't have the shipping schedule, but I think, Levi, in terms of getting the tons out, that's a priority, right? The team, they know that, and they actually caught up through the quarter, but didn't kind of clear it all. And I can't give you an exact schedule and say what the inventory would be by the end of the this coming quarter or Tianchi's year end effectively. But all I can say is that Rob and the team will be working hard to move the tons as quickly as they're producing them. There's no intent for any inventory build up or holding there or buffering around that.
Yeah, but you get the angle of the questioning, I guess. They've got form in not taking it, so...
Sure. Look, there was one quarter this time last year, and that was on, a fairly unique set of circumstances coming out of a period of very high prices without falling. They had high inventories and their plants were still ramped up. But let me give you some confidence. There is no pushback on tonnes and nominations from either customer. They're both pulling the production through as quickly as it's made.
Well, that was pretty adamant that there is no pushback at all, that Tianchi don't want the product, and it was just a shipment timing. So that probably has to give a bit of confidence for the market, I would say, because that narrative does get around. So because another thing was I learned today, the Kwinana hydroxide facility gets first preference over Tianchi taking it elsewhere.
Okay.
Not that it's probably taken shitloads at the moment because it's not really getting the output. But that's sort of how the hierarchy of that goes. So as I said, the Train 3 commissioning expected. So it's in progress. Commissioning is expected Q2 FY26. So look at their unit operating costs for Greenbushes, like $324 a tonne Aussie. So Pilbara Minerals, as we said, was 621, so nearly double. Just shows the quality of Greenbushes. Like grades dropped a bit, gone from 2.53 down to 2.1, but still miles out of Pilbara mining 1.5%. And like, you look at even the tonnes mined, Greenbushes mined a little bit less ore for the quarter, but produced over double the amount of spodumene. It's not that mining is always, there's probably stockpiles and variations there, but it's like just as a guide. And I think, because Greenbushes gets a bit better recoveries than Pilbara, so it just shows the quality of that asset. It is an absolute bloody standout.
Amazing.
Kwinana, as we said, cessation of activities on Train 2 due to the, I guess a project economics, capital allocation, just general feel of it. It probably didn't make sense.
No.
And they're still reviewing the whole whole thing as well, like Train 1 as well, like whether that makes sense for both TLEA and IGO going forward. So he was asked about the future of Kwinana and just the whole thing about him by Kate McCutcheon. I'll play that for you.
Kwinana Train 1 has been challenging. When do you think you'll be in a position to update the market on some of those metrics like costs? How much longer do you give Train 1 to get somewhere where it resembles something that's closer to nameplate? Is there a scenario where it doesn't make sense to continue that? And I guess how long until we have some clarity there? Is it a couple of quarters? Is it a year? Is it too soon to know?
I mean, Kwinana, as you called it out, it's obviously very material for our business and the cash that's demanding to sustain and develop that asset. We are obviously working through that very proactively, not just because of the impairment. It's budget time, and it's also something that's been a strong focus through 2024, and we really need to be clear about what the plan and the future for it is. It's something that we need to get to a place where we've got alignment with TLC. They bring obviously huge expertise in the lithium refining market, in those operations across China and beyond. And so we rely on that and I think draw on their expertise, but equally want to have our own view on the economics and the plans and make sure that's been considered as part of the planning and the thinking there. To get to your specific question on timing, I can't give you a date yet, but look, it's a hot discussion at the moment. It's got a lot of focus, not, as I said, not just because of the impairment. So at the very least, I do expect, and I know how material it is for our business, to be providing guidance on Kwinana going forward. So it's something I didn't do in the last calendar year because it was too uncertain for me. It was too new for us to be able to do that consistently or with confidence. I know that we'd sort of put some numbers out in 2023 and just missed them, and it didn't really help with anyone's understanding or confidence around the asset. So we will put some more numbers out. We'll work through that for the next quarterly and ongoing, and taking the 20, as I said, calendar year 25 budget into account, give you that extra set of clarity to work with.
It's pretty. I don't mind Ivan. I reckon he's got his bloody feet under the desk, pretty settled in now. But he doesn't.
Straight shooter.
He doesn't bullshit. Like he tells it how it is. And he's not like. It's not like bulk euphemisms or putting fluff on. Like he's not trying to polish a turd or something. He's been pretty bloody honest about what Kwinana is, and that they're looking at like, will it, hot discussion, and will it make sense going forward? Because if there's going to be a big impairment on the, the carrying value of the asset, and obviously the what IGO is valued at as a business, but for them to get a dividend out of TLEA, if they're not wasting it on Kwinana, you got more chance of getting that, that juicy dividend out of Greenbushes. So it'd be, and this could be how, he sort of works alongside Tianqi to, try and get the best outcome for IGO, not just the best outcome for TLEA. Could be a pretty, pivotal part of his tenure as the MD of IGO.
Yeah, no, it's huge. And I guess the interesting thing, for me, and I guess it's something to learn and look into, is it the fact that, with Train 2, yes, those sort of ceased works on that, but, those sort of comments around, even reviewing Train 1 as well, is that a comment on, sort of downstream processing in Australia compared to, other parts of the world? Is it a comment on, obviously the lithium environment as well, or is it perhaps both?
Well, and it could be is lithium hydroxide the way forward? I'm not. This is like a bloody Matt Fernley question, this one, but like, is lithium hydroxide going to be in demand enough to warrant an Australian downstream facility, or is lithium carbonate going to be more in demand? Because it appears that's what Rio Tinto are betting on. That lithium carbonate's probably going to be that's what they're going to be producing a shitload of out of brines.
So even like the preferred chemistry is another thing to think about as well. It's not sort of, I guess, sort of being quite evident to me, sort of chatting about this. It's not just as simple as, lithium's a bit poo-poo. Like there's a lot more sort of factors to consider out that, consider for that. So no, it'd be interesting to say what their assessment is of it going forward. Whether there'll be any impacts or changes to, how that operation or that processing facility looks like today. And One to watch.
Yeah, very much so. That's about it. So it'd be interesting to see if they simplify and diversify, because there's still cash, like take away the whole Winfield JV and everything. Like, I think sounds like that'll, hopefully sort itself out, get a dividend. It's not like, I know it is their debt, but they've still got, 200 odd mil. They got 720.
That's IGO themselves.
Yeah.
Yep.
They got 720 mil of undrawn debt within IGO, so that they've got to potentially deploy. So what they're, net debt 200 odd mil, if you can include the their share of the Winfield JV, but they got a quarter of a cracking asset in Greenbushes. They're Forestani's on care and maintenance now, so they're probably going to realise some value out of getting that deal done with Medallion. Probably not heaps for the gold rights and the plant and everything.
Yeah.
So they might
Not
get
enough to move the dial.
Yeah, so Cosmos is obviously a lot of that he's sort of he's inherited that one. A lot of infrastructure being put in there. There could be a miraculous friggin' nickel revival, but Cosmos needed friggin' $16 a pound to be a feasible mine deep. A lot of work, tough ground conditions and everything. So there'd have to be a massive bloody quantum shift in nickel for that to become valuable. Nova's going to be at the end of the life, so yeah, it'd be interesting to see what they do in the coming years, or if they just really simplify and hopefully reap the benefits of a lithium turnaround and Greenbushes reducing the bloody cookies for them.
Yeah.
Oh, who knows, GC? Like these friggin' chemicals and base metals, like we're
We
gold.
have stretched our comfort zones today, so no,
We're
good
and
effort.
copper.
Yeah.
Mate, how good's that director's special going? 70% open rate yesterday, mate. She's
Love it.
flying out the door. You wouldn't even know. It's just, well, you did most of it on the first day. Oh, no, I went all right.
You did. You did all right.
I got up early this morning. I'm bloody in a better
good
routine.
effort.
Not drinking as much. I'm bloody as much. Not drinking zero.
Just a slight. That's ramped down, and the dad jokes have ramped up.
Yeah. Really getting old. Love your work, JC. Got anything else today? There was bloody a few. What was there?
There's
Resolute.
a few other called Resolute, Sandfire.
Oh yeah, Sandfire.
Capricorn.
What's Sandfire? They were, I think they had pretty low cost, good operating cost performance. I think the copper was down a little bit. Oh God, I should read the bloody director's special. Where was this bloody
Moneyofmine.com.
Moneyofmine.com, everyone. Look at the value I'm just about to get out of it.
You're giving it to yourself.
Because I friggin' wrote it. Where are we? 25,500 tonne of copper, 23,000 tonne of zinc, reduced net debt by 57 million, so net debt's sitting at 288 million.
They've been chipping away at that.
So Matza and Mateo C1 operating costs performed well at US $1.51 per pound and US $1.22 per pound. So that's not too bad. But I'd say the zinc would help, like it'd drop that operating cost like copper would for gold. So what have we got? Resolute produced 340,000 ounces for calendar year 24 at US $14.76. So they obviously got the dramas with the Mali government.
Yeah, so a bit of cash out the door there last quarter.
Capricorn produced, they were already pre-reported, 28.7 thousand ounces, all in sustaining costs of $14.90. They beat Ramelius by $1.
That's great.
Sitting
$1.
with cash and gold of $363 million after raising $200 during the quarter. So $30 million has been spent on Mount Gibson so far out of the budgeted $260. BlackRock increasing the stake and go. BlackRock seemed to be going gold.
Yeah, I saw a few substantial notices. So that was one.
Gold heavy. Bloody liking gold. That was the bloody main ones. So
Moneyofmine.com if you want to find out the rest of them.
love your work, and bloody there's a shitload of websites in the links of in in the show notes for all these fellas and ladies. Mineral Mining Services, the Open Pit Gurus, Grounded, the Camp Gurus, Sandvik Ground Support Gurus, CRE Insurance.
Top of the show.
Oh, bloody
Insurance gurus.
taking you out to lunch, gurus. K-Drill, RC and Diamond Gurus. Daesh Sat, Geophysical Gurus. Saltbush Contracting, just shit job gurus. And haulage gurus. But they'll do freaking anything. Get Wet Solutions, the Bladder Gurus. And Landman Gurus. Hooroo, Money Miners.
Good week.
Objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.